Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, everybody. Welcome to the Weekly Notebook Review, May 15th edition. Thanks for our apologies slightly for the last minute invite, but wanted to make sure we got this back on the calendar and we can review things that are happening in the notebook. So we'll kind of get right into it. I know there's only a few of you that have joined live, but if you got any questions, please come and jump up, ask. We can do a little back and forth. Happy to take any questions and all that kind of stuff. Big moves today. Obviously, we with the SPX, if we kind of start with U.S. equities first, hitting right up against the call resistance level. So that call resistance level for SPX was 5,300. We're trading basically right there. So it has it moved through multiple big kind of levels. You had the Gamma wall and call resistance 0 DTE was at 52.80 coming into the day. Kind of sliced right through that and really moved right up to the top end of the risk range, which as of this morning was 52.97. I know there was a refresh range from Keith, which I think brought it down to 52.90. But we're basically trading right around the number from this morning, and really that's the top end of the risk range. In fact, kind of is obviously inversely correlated with the bottom end of the risk range for the VIX, the 30-day volatility on the S&P. That's trading down at 12.67. So that's really pushing down towards the low end of not only our risk range, but really kind of breaking down on a sort of longer term duration. Really not quite putting in a 1 month low here. That would have happened on May 10th, down at 12.56, but certainly pressing up against it. And really this today's print, if we close down here, again, there's like 2 hours left in the market, but if we close down here, this is going to be kind of the lowest level on the VIX going back, well, obviously May 10th, but then, really going back to late March. And then prior to that, earlier this year in 2024, kind of January 24, December 24, that time frame. So definitely a very interesting environment. I think the lower level volatility is certainly appears to be here to stay. If you look at kind of the calendar vol from Tier 1 Alpha that they delivered this morning, there's a big kind of near-term spike in implied volatility and just overall volatility coming into today's print, the CPI print, but now it's rolling off, right? So everybody's kind of unhedging those numbers. I think it was up north of 20 was where that implied vol was, and then let me pull it back up. I think I got deleted by accident, so I'll find that in a minute. But we're kind of, and then basically going into next week, we're looking at implied vol closer to kind of that 14 range. So you're also seeing that in the VIX 9-day, which again nobody really transacts on a 9-day basis really, but so I don't really know why the CBOE. I should probably look into that, why they did the 9-day. But if we go out kind of 9 days from now, which would be we do have OPEX obviously on Friday, so this would 9 days would kind of take us out into the following week and post NVIDIA earnings, which are on November 24th, I believe. That volatility level is right 12.11 right now. So you're really kind of looking. That's why I say it's kind of here to stay. So do not be surprised in this positive gamma environment if you get kind of continuation kind of to the upside. And really a mitigation in regards to really kind of the expected kind of range in which the S&P might trade, right? I think I tweeted out yesterday or the day before that I think it was yesterday, that it was pretty prototypical kind of positive gamma day, last kind of 2 days where we really well, certainly on Monday, I think we basically traded almost flat on the day. It was like plus 2 basis points. Today we were yesterday, we were plus 48 basis points. But that move really kind of happened near the end or kind of end of the day, trading day and going into the afternoon session. And I suspect that was just a lot of kind of just dealer flow and hedging that was kind of happening that they were having to mitigate and or transact against, right? So, my point is that, with lower vol, you get tighter bands in terms of kind of daily ranges, and you really could, I don't know how low we can go on VIX, and just when we hit the low end of the risk range, like Keith says this all the time, don't be surprised when we go back up to the top end of the risk range. Now, the top end of the risk range today is at 14.92, and that looks a heck of a lot different than just sort of a week ago or certainly a few days ago where that number was 16, 17, 18, even 19 at the top end. So at 14.92 on the top end in a bearish trend, it really kind of caps kind of your downside kind of measures, right? So to me, kind of unless something kind of big changes here in the near term, any kind of downside price action, it's really kind of a buy the dip situation. Now, there's a caveat there. If you start seeing, downside price action happening on big volume and really a spike in sort of a vol, if you track that through VVIX, that's one way of doing it, then that's a whole different ballgame. But sort of if things stay relatively the same with VVIX, pushing down towards a very low level of 75, I shouldn't say low, just a low level versus where it's been. And certainly kind of, it's not a new 1 month low, but definitely kind of, if you look back on a 1 month, 3 month, 6 month, 1 year basis, it's 75 is certainly on the lower end of that spectrum, right? So, all these things definitely factor into how you want to be positioned. And right now, I think the component here is if you need U.S. equity exposure, this is the time to get along of it, given what we're seeing from a volatility, price volume volatility standpoint. Even yesterday, the volume, be interesting. We'll see where that volume comes in for today, but suspect it'll be pretty solid. But the volume yesterday, even on that, just a little up move going into the afternoon, it was plus 16% on a 1 month basis versus the 1 month average, and plus 11% on the 3 month average, and plus 13 on the 1 year average. So that move higher, that slight move higher, 48 basis points was on volume, and that's what you want to see, right? You want to see kind of up moves on volume with decelerating or lower volatility. In terms of higher for longer, and if we kind of, this may be one of the only spaces today that's maybe doesn't talk a whole lot about CPI or inflation, but we're certainly, inflation is out there, and higher for longer remains the course or the track that we think we're on. The Hedgeye estimates have us kind of north of 4%. Into the back half of the year and going into Q1 of 25. And that looks just a lot different than the street and the consensus. So the big move out there today is obviously the US dollar. So I don't know if that's, and rates as well. So, the street, or certainly kind of the market is maybe trying to price in rate cuts. I think we are certainly in the camp that would be pretty tough to justify from a Fed standpoint or from a policy standpoint, given that today's print was certainly elevated, and it appears, at least from our estimates and our nowcast model, that we're going to be kind of higher for longer, and certainly around this level, if not higher, moving up towards 4% and north of 4% as we go out the next 6 to 9 months. So that's definitely something to be cognizant about and conscientious of. I saw a tweet out there earlier today that I was tagged in on kind of what to do here with kind of like the U.S. 10-year. Whether or not it's breaking down, I think that it's possible, but there's a big difference between kind of like, trade trends and tails. And Keith kind of talked about this in the macro show, I believe it was last week. But when you see a trade level break, like you are kind of seeing on the US 10-year yield, it can often, the trend level can be a big magnet, right? So that trend level is crucially important. And but wouldn't be surprised if we kind of like get a test of that as people digest kind of the numbers today and kind of move on, and we get sort of additional kind of economic data over the next week plus and stuff like that. So we're certainly nowhere on. Well, actually, in fact, we're short IEF and TLT. But in my mind, there's just depends on your time horizon really from an investment time frame here. I think you can kind of play the 10-year yield, or certainly the inverse of that, which would be IEF and TLT. You can play that on the short side, but do so very incrementally or a very near term basis. And it's kind of similarly with the on the long side. I really think it depends on your time horizon. If you got a much longer time horizon, if you're looking out 18 months or so, then something on the shorter end, or even kind of the belly of the curve, so IEF, SHY, maybe something like a much broader indices like an AGG, that's something that may be worthwhile kind of putting into the portfolio, and just sort of not forgetting about it, but just sort of knowing that you're in a and it's could potentially have some choppy water ahead as people navigate kind of what's going to happen from the Fed standpoint, and then what's also going to happen from an international kind of central bank standpoint. So I've been talking about a bond ETF, the international bond ETF, and BNDX. Both David Salem and I have been kind of reviewing that and been sharing kind of that. The capital allocation has a positive return prospect on BNDX, but that's something one that I think is I think there's just a bit more of a clearer picture on the international front, and certainly with the signal on BNDX looks a lot different than that kind of signal on things like IEF or TLT and that kind of thing. So I would actually, if you're kind of looking for bond exposure, I would be positioning the portfolio more towards the international side of the house because that's set up from an inflationary standpoint, and certainly what folks are already indicating and or already doing is cutting rates, and therefore getting that exposure versus kind of trying to guess and or play kind of the bit of a game of chicken with Powell here doesn't make a whole lot of sense to me. So I'd rather have that picture kind of clear up a little bit, right? Get that the waters be a little less murky, and let that kind of just unfold, because there's just better places to park capital. And again, if you have to have U.S. bond exposure, certainly TIP or TIP, so Treasury Inflation Protections, could be a good place to park it, and or as I said, BNDX or even ENB. So that's Edward, Mary, Bob. And I know Chris is listening in, and that was not the military phonetic alphabet, so apologies. Anyway, we're just going to keep on moving on from bonds here, but hopefully that answered the question. If I think I see you listening in. And then the other one here is obviously what's going to be transpiring with like inflationary assets, right? So there's a big, to me, I think there's a big not discrepancy, but there are things that are happening from a signal strength standpoint. And this is really what, this space is all about, is like, what are the signals, on the page? What is being written down in a notebook? What are the things that we're noticing that we want to be calling out, right? Certainly on a week over week basis, heading into, next week, next month, next quarter, et cetera, et cetera. So, a big one to call out, and Elms Trading, you tagged me on this one, was kind of, what do you think about the US dollar correlation between, the US dollar and Brent crude, or even kind of the CRB? You specifically said Brent, Elms, and appreciate it. It's a good call out. I think the US dollar correlation is really just like one tool in the toolbox. So right now on a 15-day basis, it's plus 0.73. But then if you go out a little bit further on the 30-day, it's minus 0.12, and then on a 90-day, it kind of ramps back up to plus 0.64 on a U.S. dollar correlation. So, I think the U.S. dollar correlations, again, as I said, they're things that are obviously noteworthy, and you need to be paying attention to what those numbers are and how they are correlated, and not really just between the US dollar and those things, but really kind of how are the things inside of your portfolio correlated to each other. And I mean, that's taking it to the next level, but we'll just stick with the US dollar here. US dollar breakdown, if you've been kind of paying attention the last few weeks, and I think I called this out at Hedgeye Live, but the U.S. dollar breakdown, even crude oil, and the energy complex as a whole, its breakdown has been kind of slowly happening over the last couple of weeks, probably 2 to 3 weeks or so, and so so like this kind of further continuation to the dollar, kind of just is right in line with what we've been seeing from a signal standpoint, and really just a weakening signal and a bit of a breakdown. It doesn't mean that it's that's bearish trend, but it just means that the near term immediate term kind of price action, it just isn't quite as strong. It hasn't been putting in higher highs and higher lows, and certainly isn't indicating on the top end of the risk range new recent highs. So that's the one thing on the dollar. So what's going to happen with the dollar? I don't know. I think, again, as I just mentioned, in terms of central banks and what everybody, basically all the positioning and jockeying around both internationally and here in the U.S., I think that just what the Fed's going to do is probably just a little bit is a lot murkier than what other international kind of central banks are doing and or indicating themselves. So I think your guess is as good as mine with the dollar right now. All I can tell you is that it's a bullish trend, but making lower lows and lower highs on an immediate term basis. So that's not really necessarily something that really screams like, hey, I want to be big in this asset allocation. But it doesn't mean that it doesn't belong there, because bullish trends are good, and it had been kind of consolidating up until this sort of breakdown the last 2 days. So consolidation in ranges, tightening up in the risk range means a lower vol, right? If you look at kind of FX vol, it's down at 7.04. So it's a pretty tight window, right, in terms of like the risk range itself and the volatility therein. Keith, again, along those lines, if you're following him on the Portfolio Solutions product, he actually added 50 basis points of UUP this morning, and UUP remains kind of at the near the top of his kind of overall Portfolio Solutions product, right? So that's kind of what Keith is thinking. I'm just telling you from my perspective that it's a little bit of a murkier, not quite as a slam dunk situation here with the dollar. And I think, generally speaking, even the energy complex, it is luckily not kind of acting the same way as the dollar in terms of being down as much, but certainly, so this kind of like inverse correlation that's happening, ELMS, is actually kind of a good thing for energy. But generally speaking, whether you're looking at crude or Brent, from an oil standpoint, they really have been like consolidating the last 10, 15 days or so, really kind of moving sideways right around this kind of like 82 to 84 range. And again, it's just like the signal just hasn't quite been as strong. Really the last 10 days, I guess, 15 days, you go back up close to 90. So signal just hasn't been quite as strong. You just haven't been, you're not seeing kind of, new recent highs being put in. And if anything, you're actually seeing an opportunity for new lows on the page. So that low end of the risk range is, what's that today? It's at 78.01. The most recent kind of 10-day low was put in yesterday at 78.02. So you're basically kind of like right there. And on Brent, that low end of the risk range is 82.25, which again is like just inside of yesterday, or actually just below yesterday's low of 82.38. So you actually have a bit more downside risk there inside of kind of the crude oil or Brent oil regime. But then on the flip side of that, again, that doesn't mean that all commodities look the same. Natty gas is putting in higher highs and higher lows. Corn is putting in higher highs and higher lows. You've got copper is obviously has been kind of all over the place. I think hard to miss any chatter about copper here on Twitter, and then conversely, the kind of breakdown in cocoa most recently in the last 15 to 21 days. But at the same time, could that just be a rotation from cocoa into copper? I don't know. Could it be a rotation, taking profits out of cocoa and having to put them into other places like corn, maybe soybeans, palladium, platinum? I don't really know. But all I know is that corn certainly looks better to me, and you'd want kind of some be increasing on opportunities like today in terms of corn futures and or through the corn ETF, CORN. on these kind of like down days. These, the corn's down, the corn ETF's down about 86 basis points today, coming off of making kind of a new highs 2 days ago. I believe it was 2090. Yeah. So we're kind of pushing up to new 10-day highs, new 15-day highs, new 1 month highs, new 3 month highs in that ETF. And that's exactly what you want to see. REMX, actually, to me, is one that I added yesterday and today, REMX. So that's rare earth metals. Kind of looks a little bit similar to corn in terms of making recent new highs on a 10-day, 15-day, 21-day, and 63-day basis. But I think there's a lot of other reasons why rare earths could pick up steam here. But I typically just go off the signal, and that signal is starting to pick up steam. And when you combine that with the signal out of China and other components like that, just inflation generally speaking, could you see a rotation into other commodity assets? Perhaps it's a head fake. Maybe it's the last bell to the ball, and she really is just an ugly duckling. And I'll be out of that bad boy if it breaks down. So don't hold me to it. But certainly rare earths looks pretty good to me. Rare earths, BNDX, even the Swiss franc. These are all things that I've been adding to the last couple of days. And I think have an opportunity here to have good cycle tailwinds behind them. What else we got going on? Apple. Pretty hard to not talk about Apple today. Last week I think it was, we were calling out. Certainly it was reviewed on the macro show by Keith. I tweeted about it as well in terms of just what was transpiring in regards to a breakout above the trend level and or flirting with it. That had been at 183. We're now sitting at 190. And we're doing so on volume with VX, APL, really, having a little bit of a 2-day kind of spike higher, but certainly significantly lower than where we were going into earnings and where we had been kind of prior to making these lows. So throughout kind of throughout April, Apple volatility was up north of 25, kind of really north of 26, and kind of traded between 26 and 31. We're now down around 20, 21 and a quarter, and really, they put in kind of fresh lows last week, May 9th, and what have you, in terms of sub 20. So could we get back into the teens on VX Apple? I don't know, but that's certainly if the rest of the volatility complex starts to act the same way, it's very likely it's going to be there. I think the interesting thing with Apple is that its eyeball discount is at a minus 23%, and that's a minus 2.1 times on a trailing 12-month Z-score. So that's a pretty large outlier, and it really means that like folks are not buying any protection here or paying up for premium from an option standpoint, which I think is very interesting. And again, I can't trade Apple because we cover it from a compliance standpoint or from a research standpoint, and therefore from a compliance standpoint, I can't be buying it. But I can tell you that if I could have, I would have, and those options would have been looking pretty good. XLK is certainly another way of expressing that same kind of concept or idea, given the fact that it's primarily made up of Apple and Microsoft. And then next up would be NVIDIA, and both Apple, NVIDIA, and Microsoft all look pretty good. Microsoft's regaining and putting in new 1 month highs again today, which I think is certainly a good indication. And it'll be interesting to see if it can recapture that kind of like 430 level, which would be new 3 month highs as well. So is that where we're headed? I don't know. I think obviously at this point, kind of going into next week, most eyes are probably on the NVIDIA earnings report, which I believe is next Wednesday. I think it's the 24th. But let me pull that up real quick. NVIDIA. The 22nd, excuse me. The 24th is options. So Wednesday, May 22nd, that is NVIDIA. And so everybody, I think kind of basically 1 week from now, it'll be interesting to see, what the markets, how the market positions, how these eyeball kind of premiums and discounts may shift going into that. I wouldn't be surprised if you see a lot more premiums kind of build up as things start to as we get closer to that event, kind of buying some protection going into those NVIDIA earnings. The other call out here within kind of like the big boys here would be Google has a negative 26% eyeball discount, and that's minus 1.2 times on a trailing 12-month Z-score, and Meta has a minus 30% and that's a minus 1.3 times trailing 12-month Z-score. So those are some other big ones to be paying attention to. The other one that was circled from an eyeball standpoint, just to kind of knock this off the page, is FXB. Interestingly enough, so the British pound is currently signaling a neutral trend, so it's kind of like bouncing right around the trend trade line within the risk range, with a risk range of 1.247 to 1.263. But that the ETF, so again, it's not a perfect correlation or what have you, but FXB actually has a negative 7% eyeball discount, and that's just a little bit, but like negative 0.5 times on trailing 12-month Z-score. So, I know I've said that on here before, Keith has too, in terms of, you really want to look at things that are kind of around 1.5 to north of 2, either plus or minus on a Z-score basis. But, realistically, you kind of use everything in order to try to get a better sense as to, where are opportunities to get paid, right? So if the British pound, if the dollar really is, starting to break down, and the pound is starting to pick up steam in regards to moving to bullish trend, and given the price action today, I can imagine that it wouldn't be bullish trend tomorrow on that page, right? Then buying some potentially having some exposure via FXB calls, what have you. You're not paying a big premium for them, and you could get some really you could be kind of catching something in a bit of a phase transition here, moving higher. So that's kind of one of the things that I'd be calling out. And with that, we can open it up to any questions. I just realized I talked for like 30 minutes, but there's a lot to review. And there's still more. So if you want me to keep going, I can. But would much rather kind of converse back and forth and answer any questions that you might have. Elms, hopefully I did answer your question on the US dollar correlation standpoint. And again, it's a good call out, man. But again, I think it's just like one thing to be paying attention to. And, correlations can kind of move and either break down and or pick up steam in either direction. And realistically, though, it's more about kind of the signal. And could this be something where Brent does also kind of pick up steam? Absolutely. But I think you're in the room at Hedgeye Live when I mentioned the fact that, I'd rather pay $250 for natty gas, which is basically where we are now, and for Brent oil and or kind of oil in general, I'd rather pay like $85 for it, for Brent specifically, where I know it's sort of like with that low in the risk range, it really starts to kind of creep higher and no longer kind of signals a potential lower low on a 1 month basis, right? So kind of where it picks up a little bit more near term signal strength, and then hopefully in time, as if it kind of consolidates around here, that's actually really positive, because as time and space moves out, your 10-day kind of price action is going to kind of basically be here between 82 and 84. Your 15-day would kind of do the same. And then if we start to break out on a shorter term duration up to 84, 85, that's really when it's a great example where I'd rather get confirmation in the price action rather than trying to just pick a bottom and sort of, have it be, like dollar's breaking down, Brent's got a, US dollar, in a positive, or maybe the positive correlation is going to be burning off, et cetera, et cetera. So that's kind of how I'd be thinking about it. One that I haven't talked about is gold. Excuse me. Gold's got a very slight inverse correlation on a 15-day basis of negative 0.39. And obviously he's having a pretty good move today, back up to north of 2390. Excuse me. With the top end of the risk range at 2386 today, low end at 2303. And this is kind of exactly what it's sort of the ideally, if we see kind of Brent do this in the future, but kind of gold basically spent 10, 15 days kind of consolidating and trying to figure itself out between basically 2360 and like 2300. And then late last week on Thursday, Friday, it broke out to the upside on both the near term 10-day and kind of 15-day basis. And that's exactly right. So kind of in this situation, it's very similar where I actually have more confidence paying up here at like 2390 or something. Again, it doesn't mean I buy it today on a green, like, plus 1.38%. It's up to 138 basis points. But, tomorrow, next week, whenever you get a little, maybe a red day, you end up kind of building back up that position in gold if you've reduced it, because again, just that signal strength sort of has returned, and hopefully here, and again, like hopefully if things continue, you're actually going to see that top in the risk range start to indicate not just kind of near term 10 and 15 day kind of highs, but you're also going to see that it'll start to indicate 1 month, 3 month highs, which were put in mid-April, and that closing price is 2413.8. So again, that's exactly right. So it's one of these things where I know it sounds counterintuitive in regards to I want to buy low, sell high, but you want to buy low when the low is likely close to the low and or the bottom. And so in this case, you're kind of, you hopefully still have some exposure to gold from prior to, right? And you're kind of just been running it at your min or mid-sized positioning, maybe building it up a little bit. And now you can really, maybe get a little bit more aggressive and be more confident taking it up to your max sizing so that you can, kind of ride the momentum and trend higher. So hopefully that's helpful. And GBZ, gold vol is kind of moving higher too. So it's been kind of elevated last month plus, kind of north of 15. So it'll be interesting to see kind of where that gold vol stands. And I think that's another big one too, is like with the gold vol at 17 here, or close to 17, you don't take it as big as you do traditionally, right? So on our kind of like, position sizing sort of graph, we consider gold a currency, but that currency is typically a max of 12%. But currency vol usually is like sub 9, right? So at 9 or let's just say sub 12. So like sub 12 volatility, that's a max 12%. But at 16, 17 volatility here within gold, that might only be an 8% position, or maybe a 10% position. It just depends on your risk profile and risk tolerance. But I think that's a big thing to be conscientious about. And even in like April, when gold volatility was significantly moving higher, it basically moved from like 12 in March all the way up to 22, because of that spike in gold. And even in that ramp up, like you just naturally, even if you're keeping it at your max, you're just naturally reducing the overall position sizing and taking basically profits, because you're from your rules standpoint, you can't have as big of a position on. So that's another big thing to be thinking about here too. And that kind of goes both ways. So whether it be oil volatility, so we're just kind of talking about oil. So oil vol is down at 27, which is a kind of a great number in terms of on the lower end of its spectrum, and which means you can get kind of bigger naturally from a position sizing standpoint, and that could be a good thing, right? So you really want to kind of see oil sort of start to consolidate, continue to consolidate here, maybe put in a near term kind of 10, high on a 10-day basis, which would really just be, it wouldn't take much really. It would just needs to kind of close north of 79.5. And then that would kind of get me kind of back interested in oil. And so I'm talking about crude oil here, CL1. But yeah, so. All right, we'll open up again. As I mentioned, any questions? Happy to review really anything. Haven't talked a lot about Europe, so if you got any questions on Europe, happy to address them, or I can just pivot towards that. All right, cool. Not everybody jump up at once. Love it. So let's pivot to Europe then. So VGK is one way. So that's Victor George Kelvin. Again, Chris, bear with me. You're going to kill me. But it's Victor George Kelvin. And that's with a K, not a C. I realize that some people might spell, that'd be Calvin, so Kelvin. Anyway, so VGK, I mean, talk about a great looking exposure, new highs on a 10-day, 15-day, 21-day, 63-day basis. It is bullish trade and trend, and it's doing so on volume, right? So this is exactly kind of what you want to see. This is exactly what you want to see in terms of a positive kind of allocation inside of your portfolio. David Salem and I have been talking about it at Capital Allocation for a number of months now. So hopefully you guys have some form of European exposure or Eurozone exposure inside of the portfolio. But things continue to look really good from an economic data standpoint. We obviously also have yes, we got, so things look like economic data rolling in is looking good from a nowcast model standpoint or from a quad standpoint. We certainly our estimates are that it is in kind of quad 1, quad 2 type framework. So that obviously is beneficial. And then most importantly, as I just mentioned, the signal continues to really look strong. And that goes across multiple European assets, but certainly, sometimes it's just easier to look at like the broader basket, like a VGK or a GSG for commodities exposure. But if you go kind of dive under the hood, you've got the UK, EWU would be the ETF here in the US. That again, that's putting in new highs. You could look at even Eden, EDEN, which is Denmark. Again, same thing. Spain. Looks very similar. I mean, you really just go across the Eurozone complex, and you realize very quickly that it that equity market looks very strong, and I mean, I think up until today or the last couple of days, where and one of the big reasons why we're talking about the Eurozone is just because the U.S. equities were looking pretty murky, right? And in fact, we're kind of flirting with bearish trends, and volatility was spiking higher and all that kind of stuff. Whereas Europe and the Eurozone in particular was not, right? And so you had some really good opportunities to add to those assets in the last kind of month, and hopefully you did so even in the last kind of 15 days. So hopefully you did so too across the board. The other one too would be EMX China. EMX China. Again, that is actually starting to kind of pick up good momentum again. It was sort of kind of, I don't know, just kind of went sideways a little bit here for the last little bit, but it's now back up to putting in. Again, if we close up here, we're going to put in fresh 1 month and 3 month highs. So that's obviously a good thing. So again, whether that's because China's economic data is picking up or just generally speaking, the signal is liking some emerging markets, it really doesn't necessarily matter to me, but all that really matters is trying to make some money and having on these exposures. Again, I know it sounds like I'm saying it's in hindsight, but we've been long of EMX China probably since, I have to look at our model, but it's been many months, if not going all the way back to December or even November. So I think EMX China is really a crucial one to have in the portfolio, just from an overall kind of variety in regards to asset allocations, perhaps trying to minimize some of the correlations. EMX China, VGK. You can have some GSG exposure, some commodities in there. You can have some BNDX. These are really good assets or good positions to have on. And the cool thing is that David Salem's team at Capital Allocation, they put out actually some model portfolios last week. They released them actually, maybe it was 2 weeks ago on May 9th. And so if you're interested in that, interested in learning more about kind of the longer term kind of model portfolio from David and Capital Allocation, please reach out to support at hedgeye.com or sales at hedgeye.com, and we can try to help you out. But so that just want to kind of highlight that. You'll notice that those four exposures play a role in. Actually, I don't know if EMX China is in there. Let me double check. EMX China is in 2 of the portfolios, not all 3, but yeah. So, cool. All right, guys. Well, if there's no questions, then we'll just wrap up here. It's been about 45 minutes. I think we covered a lot. Hopefully you have maybe learned something. I don't know. And look for some pretty cool announcement probably next week from me, which will be great. It's going to be a little internal kind of pivot for your main man here, Robbie Mack, and which should be fun. So look for that next week. We'll continue to do weekly notebook reviews. Maybe be moving them to kind of like every other week, though, just where my time's probably going to be picking up in regards to needing to focus on some other aspects of life and work. But I'll kind of keep that. I'll keep everybody posted. But at the very least, we will certainly see you next Wednesday, likely in the either afternoon around this time, 2:00 or 4:30. All the best to all, and we'll see you soon. Thanks for tuning in.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.